So we have our specific agenda still: the market, treasuries, the economy, the Fed, alternative investments, and then our takeaways. So let's just jump in. The S&P 500 index, this is actually as of a couple days ago. So we're up to 5426 as of today. So one of the things we had talked about is that we expected the market to run up and likely peak near mid to late June, and then kind of go sideways through the summer, and then potentially start a decline after the Fed meets in Jackson Hole. And then after the election, I expect the brakes to be taken off and realistic economic numbers to start coming out. This is a chart that shows the S&P 500 returns historically versus the 10-year Treasury yield. And you'll see anytime the market and the yield create a gap, represented by the red arrows here, they snap back together. So we're in one of those periods where there's a significant gap between the two, and they're likely to snap back together and have yields either exceed the returns on the market or have the market drop to a significant extent below the yields. Okay. So I'm going for the latter of those two. I do believe that bonds are going to be the safe haven and yields are actually going to be cut. And so you're going to see that snap back primarily with the market coming down. So 20-year treasuries, normally I show the value of the treasury fund that we use. Yields work inversely to what the value does. So if the yield goes up, that means the bond value goes down. And if yields go down, bond values go up. So that's why when we talk about the Fed cutting interest rates, that's what drives bond values up. So I do anticipate we're going to see the Fed start cutting. So we're looking at the TIPS yield. This is for a 10-year. The treasuries were a 20-year. And you'll see that 10-year is tied to inflation. So it's historically a much lower yield there than you're getting on the regular treasuries. And I strongly believe we're going into a stagflation period. And to remind you all, stagflation is when you have a weak economy, but you still have inflation. So things still get more expensive despite unemployment being high and the economy and growth being slow. So all of that being said, there was a specific question this week about the recovery of these bonds from their peaks 2 years ago or about there when they hit their high. And what is going to drive that? So for example, today, everything is up. The long-term treasuries, the long-term TIPS are all up 1.5% or more. That's been caused by the lower than expected inflation number. So we'll talk about that in a minute. But ultimately, what we're going to see likely after the election is the Fed cutting interest rates. And I think cutting at a fairly quick clip. So they may cut 4 meetings in a row and get that rate down to try and avoid the economy crashing. Okay. So when I mentioned that the inflation rate came in lower than expected, one of the things that we see quite often is they announce a number and then they adjust it. They quietly come in the middle of the night and adjust that number. So this is a blog post that I did a week or two ago that actually is tied to an article where they talk about they just revised down the GDP number for the first quarter of the year. And of course, report revised to show worse than expected numbers. We're not surprised by that because they do that constantly, especially in an election year, to make things look better than they are. So if you look at that 1.3% for the first quarter of this year, inflation at the same time is about 2.6%. So if inflation is double the GDP growth, we're actually losing to inflation. Our economy is growing slower than inflation is rising. So we're actually negative 1.3%. And I would argue even a little bit more than that. Just recently, they came out and had a fairly decent jobs number. Don't be surprised if that gets revised before the end of the month. They just came out with an inflation number that was lower than expected. Again, don't be surprised if they come out and revise that up. And by the way, I did want to add, I'm going to try and do a blog post each week. Those are on our social media and our website. And I'll pick an article or something that was of interest and give a quick synopsis or opinion on that article. Okay, so here's our Cetera Fedometer. So we obviously have the aggressive Fed policy and the conservative policy. In this case, they're suggesting that it's going to be a more conservative policy. I think we're going to see that swing, like I said, around August, September, when the Fed meets in Jackson Hole, and we'll start to see that get up there. And I wouldn't be surprised to see the needle pinned to the higher, more aggressive Fed action by the end of this year. Okay, so alternative investments. As I said, everything is up today. So gold is up again, higher than it was at this point. I anticipate we're going to see this through the end of the year, probably through next year. I believe gold and silver should continue to do well. Let's move on to silver. I do expect silver will outperform gold. And so you'll see it here at $29.84 an ounce. I do expect to see it north of 40 and maybe significantly north of 40 sometime in the next 18 to 24 months. So it's finally broken out and gotten above 30. And I think that trend will continue again for 18 to 24 months. There's some other alts that we had been talking about, and compliance does not want us putting charts up for these or overly discussing them because we can't recommend them specifically as investments. For all of those alternative investments, where they may fit in your portfolio is maybe as 2 to 5% of the overall portfolio. And I believe that 2 to 5% will do well even when the stock market as a whole is going down. And of course, the Other area we always talk about is energy. Energy historically does really well in election years, and I have a basket of stocks that I use. So if anybody wants to talk about that, we can talk about that as well in an individual call. I do expect, again, the market to peak here in June. I don't think we'll see these highs again for several years, maybe 2, maybe 5. And what we're going to see is the market goes sideways through the summer and then likely begin a significant drop. So one of the things that we're looking at and why we believe that is the overall valuation in the market. It continues to be above a price to earnings ratio of 25. And only 3 times in history has it ever been above 25 besides now. And all 3 of those ended up in a 50% or more correction in the market. Doesn't mean it's going to occur this time. But if you look at all the other economic variables going on, I don't see a way to avoid it. So at some point, we have to just rip the Band-Aid off. I don't think that happens before the election. And I think after the election, especially if there's a new president, I believe you're going to see the outgoing president and their staff kind of try and get everything that should happen to happen before that changeover in power. So it could be a very volatile end of the year and beginning of next year. As far as the investments, given what we're looking at, I believe you should be at about 20% long-term treasuries and 20% long-term tips. Some of us are there, some of us are close, but I do believe that's where you're going to see your biggest growth over the next 18 months. Silver and gold, I do believe will continue to do well as we discussed. So keep those positions. Be prepared to make some shifts as the market comes down. And again, our philosophy for investing is when the market's overvalued, we invest in a way that you're not going to see 15 or 20% returns in a year, but you're also not going to see 15 to 20% downside, or 50% as it were, likely to happen. But then when the market is fairly valued again, we have all our powder ready to become more aggressive and find the right types of stocks and invest in a way similar to Warren Buffett, where we find value stocks at value prices and let those dividends compound. So that's the goal. That's where I see things going. If you have any questions specific to your accounts, certainly feel free to schedule a time. Wow. So we put this presentation through compliance, and this is all the things they've added to it. So feel free to read all of that, take a screenshot. It's a great insomnia cure.